Financial ratios make it possible to compare and evaluate the financial aspects of a business from one accounting period to the next. To set up financial ratios, click Management, Operational Benchmarking. From the menu on the left, click Financial Ratios. Specify the options for your report from the Options panel. First, choose your accounting method. Your options include cash or accrual. This choice is generally the same choice you would make when producing your income and expense statement. Next, choose the As At date. Account balances as at the end of this date will be included on the report. You may enter the date directly, or click the drop-down menu to choose a date from the calendar control. Several financial ratios require specific account balances to ensure an accurate result. To ensure the accuracy of the financial ratios, click the link for each account class and select the accounts that should be associated with it. Current assets are cash and any other asset that, in the normal course of operations, is expected to be converted into cash or consumed within 1 year. Current liabilities are debts that will be payable in the current year. Cash equivalents are any current asset that can be immediately converted into cash without disrupting normal operations. In the Values section, select which value should be used on your report. Your options include book value or fair market value. The book value is the value of the asset's purchase price less the total of all depreciation claimed on the asset. The fair market value is your estimate of value that the asset has in the marketplace at the current time. Finally, you may check the Show 5-Year Comparison box to display a 5-year comparison report based on the options you selected above. This report will calculate 7 financial ratios. The acid test ratio measures the proportion of cash or cash equivalents to the current liabilities. It answers the question, if I had to pay my current debts today, could I do it? A ratio of 1 means that you can pay all of your current debt today. The current ratio measures the ability of the business to meet financial obligations as they come due without disrupting normal operations. It is very similar to the acid test. However, it takes into account all of your current assets, not just cash and cash equivalents. Things like inventory, which may take a little longer to sell, are included in this ratio. A ratio of greater than 1 means that the business is considered liquid. The debt structure ratio measures the proportion of total debt due and payable within the current year. A high structure ratio may indicate liquidity problems. In general, any ratio over 0.2 should be looked at. Be careful with this one, as it may be misleading. A business with no long-term debt would have a poor ratio, as the majority of the debt would be short-term. The debt-to-asset ratio is a measure of the extent of creditor financing used by the business. It measures the proportion of total assets that are financed by debt. The higher the value of the ratio, the higher the financial risk. Generally speaking, 0.4 or less is lower risk, and anything over that depends on the comfort level of the business owner. The equity ratio measures the proportion of total assets financed by the owner. The higher the value of the ratio, the more solvent the business. Similar to the debt-to-equity ratio, it all depends on the comfort level of the business owner. Generally speaking, a ratio of 0.7 or higher is considered to be low risk. The debt-to-equity ratio measures the extent to which the creditors have financed the business compared to the owners. The higher the value, the greater the proportion of financing that has been provided by creditors. This ratio depends solely upon the comfort level of the individual. Generally speaking, this ratio is high for new farmers or those in expansion. Finally, the capital turnover ratio indicates the extent to which a business utilizes its assets to generate revenue. The higher the ratio, the better the assets are being used to generate revenue. This indicator generally needs a comparison to be effective. Comparing this value to a value generated by another farm of similar size and composition can be very useful when determining if you are getting the most out of your machinery. It can also be used in a year-over-year comparison to evaluate trends within your own farm. Click Generate to view a printable report. Click Save to save your current report options, or Cancel to close the operational benchmarking dialog window without saving.